I used to think finding good investments meant surging through thousands of stocks, reading endless reports, watching the news and the stock market every day, basically turning investing into my second full-time job. Then I found something hidden inside the work of some of the greatest investors of all time, Warren Buffett and Joe Greenblatt. They were both doing it. It was right there in their books, their letters and their track records. And a small corner of the market where the same kind of opportunity appears again and again. They never really made the headline. When companies break themselves apart, Wall Street steps back. Funds are forced to sell shares they never wanted. Analysts stop paying attention. Nobody likes uncertainty. Nobody likes change. And because of this, for a short period of time, price disconnects from value. I'm not a professional investor. I work a normal 9 to 5, but this gave me a much easier way to find great investment ideas instead of randomly surging through the entire market. And right now, in 2026, some of the most interesting situations I've seen in years are happening. Once you see the pattern, you will never look at company breakup the same way again. Let's go into it. When I started investing, I was just following stock tips. Someone said, buy this, so I bought it. I had no idea why. No idea what the company was actually doing. No idea what the company actually did. And absolutely no idea when to sell. Most of the time, I had no clue why anything was happening. I remember thinking, the only thing I really need is a magic ball. Something that can just tell me what the price will do tomorrow. Because without that, this felt like a casino. And that exactly was it for me. Then the dot-com crash hit in 2000 and I lost almost everything I put in. I stopped completely. I was so done with investing. Then one day, I'm not even sure how much later, I walked into a bookstore and I saw this book about the richest investor of the world. I picked it up, but before buying it, I thought, wait, if this is even for real, this person should be on the Forbes list. So I walked over to the magazine section, found Forbes, started looking through it, and there was this name, Warren Buffett. Okay, this is real. I bought the book. And for the first time, investing actually made sense to me. The idea was simple. You're not buying a piece of paper with a stock ticker on it. You're buying a small piece of a real company. You're buying a small piece of a real business, and the stock price and the real value of the business are not always the same thing. There was this idea called Mr. Market, an emotional guy offering you a price every single day, sometimes too high and sometimes too low. And most of the time, the price had nothing to do with what the business actually is worth. Suddenly investing stopped feeling random. I started looking at company differently. Coca-Cola, Gillette, businesses normal people actually understand. Things you use every day. This hit me hard. And what made it even more powerful, Buffett had warned about the dot-com bubble before it crashed. While everybody else was buying anything .com in the name, like me, he simply stayed out. He did nothing. It did not make sense to him. He did not need a magic ball. He just understood what things were actually worth. But then I ran into a huge problem. Buffett's approach sounded very simple, but actually doing felt almost impossible. Hundreds of pages of research, company after company after company. And I remember thinking, how can I ever compete with people like this? I had a normal job. I could not spend all day researching stocks. And even when Buffett talked about special situations, where you roughly know when something will happen, the examples sounded impossible to find in real life. Things like swapping company shares for coconut beans to make profit. How the hell would a normal person ever find chances like that? And even then, these Buffett-style chances are rare. You can wait years for the right one. And I did not have years to wait. Then I found the book of Joe Greenblatt, about special situations. And then suddenly everything clicked. These company breakups happen every single year, and they always create the same situation: forced selling, confusion, things being ignored, and price that stop matching what the business is actually worth. So, Warren Buffett taught me how to think about investing. Joel Greenblatt showed me where to look. And for the first time, investing started to feel possible. After I read Hagstrom's book about Buffett and then found Greenblatt, I started looking more carefully at what Buffett had actually done earlier in his career, before Berkshire, before he became the most famous investor in the world. I found something I completely missed. This was not the Buffett most people know, not the Berkshire Buffett, the Coca-Cola Buffett, not the buy and hold forever Buffett. This was the young Buffett, running a small investment partnership, building his fortune from scratch, starting with almost nothing. In his letters to his partners, he wrote about something called workouts. This is what he actually wrote. These are securities whose financial results depend on corporate action rather than supply and demand factors. They are securities with a timetable where we can predict, within reasonable error limits, when we will get how much. This was completely different from how most people think about investing. He was not waiting for a great company to become cheap. He was looking for corporate events, mergers, liquidation, breakups, situations where you roughly know when the outcome will happen. And he was doing 5 to 10 of these at any given time. Results usually felt between 10 and 20% per year, just from these situations alone. This was a core part of how he built his early fortune, and almost nobody talks about it. Because at some point, Buffett got so big that the situation became too small to move the needle for him. So he moved on, focused on buying great companies and holding them forever, and the world only ever saw that version of him. The workout Buffett used quietly disappeared from the story, until I found it. Then there is Greenblatt. He runs a fund called Dotcom Capital. And for 10 years in a row, largely by focusing on these exact same situations, he averaged 50% returns every single year. Let that sink in for a second. Buffett was making 10 to 20% a year from workouts. Greenblatt was making 50% every year for a decade. He wrote about exactly how he did it. I will put the book link in the description. So when I say this works, I'm not guessing. I'm not sharing a theory I read on internet. I'm pointing to two of the greatest investors in history. Both of them using the same approach at different times, getting super results. And both of them connected to one thing: time-sensitive corporate events. Situations with a rough timetable. Not if, when. And that is what it makes it manageable for a normal person with a normal job. Now let me show you what this actually looks like in real life. Sometimes a company decides to break itself apart, and there are usually a few reasons why this happens. Sometimes the people running the company decided themselves. Two very different businesses under one roof, and they realize each would be stronger and more focused on its own. Sometimes a big investor pushes for it, someone who bought a large piece of the company and says, break this up. The two pieces are worth more apart than together. Sometimes the government steps in. The company has become too powerful and needs to be split up. And sometimes the reason is simpler than all of that. The company has become so complicated that nobody really knows how to value it anymore. Too many different businesses, too many moving parts. Analysts do not know whether to call it a tech company, a manufacturing company, or consumer brand. So basically they cannot label the company. So market just puts a low price on it and moves on. Wall Street does not like complicated. Wall Street likes simple. And when that complicated company finally breaks apart, suddenly each piece is clean, focused, and easy to understand. And often, the two pieces together turn out to be worth more than the whole thing ever was. So it does not matter what reason started it, the results are always the same. One big complicated company becomes two smaller, simpler ones. And that's where it gets interesting. Now here's what most people miss. Right now, a huge amount of money is managed by ETFs and large investment funds that automatically hold companies based on certain rules. When one of the companies breaks itself apart, those funds suddenly own a smaller company they never planned to hold. Maybe it's too small, wrong industry, too illiquid, outside their own rules, so they sell it. Not because it's a bad company, just because the rules say sell. And this happens all at once across hundreds of funds and thousands of investors, all getting shares they never wanted, all selling at the same time. Almost nobody stopped to ask, what is the business actually worth? And when thousands of people sell at the same time, the price can fall fast. At the same time, analysts who covered the big companies stop paying attention because now there are two smaller companies instead of one big company. Less research, less coverage, fewer people watching. So what you end up with is this. A business that might be perfectly good, sold off by funds, investors who never wanted it, ignored by analysts who moved on, trading at a price that has nothing to do with what it's actually worth. For a period of time, the stock price and the real value of a business can become two very different things. Now I want to show you that this is not just a theory. It has been real for a long time, and it's still happening today. Let me show you three stories. The first one, 1954. Warren Buffett is 24 years old. He finds a chocolate company called Rockwood. The company has a huge pile of cocoa beans sitting in a warehouse. And because of a tax rule, if they gave those beans back to the shareholders, instead of selling them, nobody had to pay tax on it. So Buffett bought the stock, rode the subway to the office every day, swapped his shares for cocoa beans, sold the beans, and his only cost was the subway tokens. Most of people took the quick profit and walked away. Buffett saw something they missed. When a company cleans house, gets rid of the stuff that does not belong, the value of what it's left behind can explode. He held on and walked away with a serious profit. The second one, the year 2000, a big company called Dun & Bradstreet decided to break itself apart. And one of the pieces it breaks off is a business called Moody's. You have probably heard of Moody's. They rate debt. If a company or a government wants to borrow money, they need Moody's to say how safe the debt is. Only 3 companies in the world did this job. If you wanted to sell bonds, you needed Moody's. No way around it. No real competition. Nobody could copy it. Just a quiet business making a huge amount of money every year. But when it got broken off, nobody wanted it. Funds sold it because the rules said so. Analysts stopped covering it because it was now a smaller separate company. The price dropped away from what the business was actually worth. And Buffett was watching all of this. He already bought into Dun & Bradstreet in 1999, right when the breakup was announced. He paid $248 million when Moody's landed in his account. He just kept it, never bought another share. Greenblatt saw the same thing in his own way. He sat down and compared Moody's to Buffett's Coca-Cola investment, just to figure out if the price was fair. And what he found stopped him. He called it something he had never seen before. A business so good, it almost never needed to put money back in to keep making more money. It just kept on producing cash, year after year, with almost nothing standing in its way. There's actually a video about this exact comparison of Greenblatt. I will put the link in the description. It's worth watching. After this, of course. Greenblatt bought at roughly same time as Warren Buffett. About a year later, when the price had caught up to the value, he sold it for 50% return in 1 year. He was very happy. He moved on to the next. Buffett never sold. That same $248 million is worth over $12 billion today. A 400% return over 25 years. Two different approaches, both right, but here's what this really shows. Neither of them predicted the future. Neither of them had inside information. They just understood how it works. Funds were forced to sell, analysts walk away, the price dropped below the value, and they were ready when it happened. The third one, right now in 2026. I was reading the Wall Street Journal a few weeks ago, and I saw that S&P Global just announced they are breaking off their car data business. They are calling it Mobility Global. It includes Carfax, the company people use to check the history of used cars. Expected to be done by mid-2026. And when I read that, I immediately thought of, because S&P Global is literally Moody's biggest competitor. I think they own together 80%, each 40% of the industry. Same type of business, same mode, same kind of business Buffett has held for 25 years and never sold. And now they are cleaning house. Get rid of a piece that doesn't really fit. The car data business was always the odd one out. It came from an old deal and never really belonged with the rest. And when that breakup happens, the same thing kicks in. Funds will get rid of Mobility Global. They never asked for it. They will sell without even looking at it what they own. The price of Mobility Global will likely drop fast. And S&P Global itself, the core business, might trade cheaper than normal during all this confusion. Now, I'm not saying, of course, go out and buy this tomorrow. That's not the point. The point is, I did not need to be a genius to spot it. I just knew what to look for. Same pattern, same thing happening. Different company, different year, not a magic formula. Just a repeatable place to look. Now, obviously, not every company breakup is automatically a great investment, of course. Some are amazing and some are completely garbage. And in the beginning, I had no idea how to tell the difference. But over time, I noticed a few things that I naturally do every time one of these situations appears. Not a magic formula, not a complicated system. The first thing I do is just I read what is actually happening. What is the deal? Why is this company breaking apart? What are the two pieces? And straight away, I want to know one thing. Who pushed for this? Did the people running the company decide this themselves? Or are there any activist investors behind it? Someone who bought a big chunk of shares and is now pushing hard for a breakup because they believe the two pieces are worth more apart than together. Because when a smart, motivated investor with serious money at stake is already pushing for it, that tells me something. It tells me someone has already done a lot of work, someone already believes the gap between the price and value is big enough to fight for. That's a very different situation from a normal company reorganization. Then I ask myself one simple question. Do I actually understand this business? And I do not just mean do I know what it does. I mean, can I roughly see where it's going? Can I picture this business in 5 years? Is the market it operates in growing? Does it have something that is hard to copy? Is the direction clear? Because if I can see where the business is going, even roughly, that changes everything. I'm not just buying something cheap. I'm buying something cheap that I believe will be worth more in the future. If I cannot see that, I move on. This alone removes most situations from my list. If I do understand it, I try to get a rough sense of what each piece might be worth. I look at similar companies that are already trading on their own. What does a business like this normally sell for? This is not a precise calculation, just a rough map. Does the price seem too low, too high, or about right? Then I wait. From the moment a company first announces breakup, the moment it actually happens, is usually somewhere between 6 months and 2 years. That's a long time. That means there's no rush, no need to jump in on day one, no need to make quick decisions with limited information. I just let the information come to me. Over the following weeks or months, the company releases more details. The picture gets clearer. I check how the debt is being split. I check what the insiders are doing with their own shares. And I check which piece Wall Street is ignoring. Because the ignored pieces is almost always where the biggest gap between price and value appears. And then I ask myself one final question. Is this just for a short period of time, or is it actually a great business I would be happy to own for years? Because I think about this in two different ways. Some of my portfolio I use for the quick gap trades. I see a big difference between price and value. I buy, I wait for the gap to close, sell, move on to the next one. But another part of my portfolio I keep for something different. The situation where the breakup hands me a great business at a price I would normally never get. That is what happened with, for example, the Magnum ice cream company after the Unilever breakup in December 2025. I became a shareholder, not because I expected a quick pop in the price, because I could see where this business is going. Think about what happened here. For years, Magnum was just a small division inside a giant company. Inside, ice cream was important, but it was never the main focus. It had to compete for attention, for money, for resources with dozens of other businesses inside the owner, Unilever. Now it's free. The world's biggest standalone ice cream company, and management can fully focus on one thing: growing the ice cream business, making decisions, especially for this business, not for dozens of unrelated divisions inside the giant company. That is a very different situation from before. Strong brands that people all over the world already love. Magnum, Ben & Jerry's, Cornetto, a huge share of the global ice cream market. The breakup handed it to me at a price I would not have got it otherwise. Finding a great business, finally free to be itself at a moment when the market is not paying attention. That is the best version of the whole strategy. I only need one or two situations like this a year. That's more than enough. When I started investing, I felt completely lost. Buying random stocks, watching numbers go up and down, having no idea why anything was happening. Then I found a way of thinking that finally made sense. Then I found a place to look. Not the whole market, not thousands of stocks, not endless reports, just a specific kind of situation that appears where a company breaks apart, where the market steps back, where price and value come apart for a short period of time. And somewhere in that window, if you know what you are looking for, there's an opportunity. I made losses, still do sometimes, but the wins have completely destroyed those losses. PayPal, Match Group, the company behind Tinder, both came out of company breakups. Both gave me returns of a few 100% in just a few years. And this strategy overall has given me better returns than the S&P 500 by a lot. Not because I'm smart, on the contrary, it had everything to do with this strategy. Being in the right place at the right time with a simple process. That's all what it was. I'm not a professional investor. I have a normal job and a normal life. But this way of thinking has made investing feel possible for the first time. Not easy, not guaranteed of course, just possible. And that's all I was ever looking for. If this way of investing interests you, just let me know.